welcome to my YouTube channel in which I talk about personal finance and investing. And today we are going to talk about what millionaires and some successful fund managers did during a bear market or a market crash and what we can learn from them. Now, no one is immune from a market crash. Everyone have to deal with it, no matter how rich you are. But it is how you deal with it that determines whether you make money out of it. Let's go. Now, US millionaires own roughly 90% of all individually held stocks in the US. And recently, CNBC ran a survey which surveyed 750 respondents in the US with at least $1 million in investable assets. So this was just before the market went into a bear market. Now, a bear market just means that the stock market dropped 20% from its peak. And this happened in 2022 in June, whereby the stock market dropped 20% from its peak reached in January 2022. So let's see what the millionaires think. So the millionaires surveyed rank inflation as the #1 risk to both the economy and their personal wealth. This is the first time since the survey began in 2014 that inflation has topped out all other risks in the ranking. Nearly 40% of the millionaires surveyed said that they have planned to or have already made changes to their portfolio due to inflation. 31% of them have sold off their equities. 41% said they have purchased more fixed-rate investments, for example, bonds. And 44% said that they are keeping more money in cash. Only 35% said that they have purchased equities. Now, the survey was ran in May 2022, which was before the bear market was declared to be official. So millionaires were already reacting in advance by making changes to their portfolios. So if you think that inflation will get worse or recession may come and then get worse, then you should make changes to your portfolio, make changes to your spending and investment decisions in anticipation for the future so that you will be well prepared to handle what comes next. So let us talk about what some successful fund managers have done in the previous market crashes. Let's talk about the global financial crisis in 2008, which was the worst US recession since the US Great Depression in 1929. Now, prior to the global financial crisis, Michael Burry, a hedge fund manager, shorted the US housing market. So he noticed that US housing prices were too high, that it was unsustainable. A lot of subprime borrowers, which were borrowers with poor credit health, they do not have high or consistent income and were not that really able to finance their mortgages with the paychecks that they have. But they were able to get housing loans easily because banks at that time were very lax in their lending standards. So a lot of people were able to get new housing loans and more people started buying new houses. This drove house prices up, and Michael Burry thought that, these borrowers are of subprime quality. It is very likely that a lot of them will default on their mortgages. And if that happens, then the housing market will come tumbling down, house prices will fall. So he betted against the US housing market by purchasing credit default swaps, which will make him profits when house prices start to fall because people started defaulting on their mortgages. And that was what happened. He managed to pocket $700 million in profits for his fund's investors and also took home a personal profit of $100 million. So in this case, he made a huge directional bet and made great profits from it. He noticed something in the market that was unsustainable while a lot of people did not notice it. So he did his own research on the housing market, found out flaws, and then betted against it and shorted it. So what Michael Burry did by shorting the US housing market, it may be risky because we know shorting is risky, but if you have enough conviction based on your own market research, then you can actually make good money out of it. So Michael Burry even had a movie modeled after him called The Big Short, which is actually a pretty interesting watch that you can check it out to find out more about the global financial crisis and how Michael Burry was able to profit by shorting the US housing market. So recently in 2021, he also warned people that the mother of all crashes is coming. So he warned people to stay away from risky assets like technology stocks, meme stocks, cryptocurrencies, all these risky assets. And he himself went to short growth stocks like Tesla, Apple, and ARK, which held a lot of technology stocks. And what happened? In 2022, we saw the US stock market crash, and a lot of technology stocks crashed by more than 50% from their all-time highs. So it turns out that Michael Burry was right again. So if you want to be like Burry, then you have to study the market closely. Look at each area of the market. Which area is overvalued or undervalued? What is happening to the market right now? What is happening to economy? What is happening to the dollar? What is happening to the housing market, the consumer staple sector, every part? You have to closely watch and then make a conclusion out of it and make your bets according to what you were able to conclude from your own market research. Now, this type of betting may not be for everyone, because you will have to understand market cycles very well. You have to be experienced enough to do so. But well, everyone starts somewhere, so if you're interested, then do start learning about economics, market cycles, valuations, what drives each market, each sector, and then start from there. Now, apart from Michael Burry, another hedge fund manager, John Paulson, also betted against the US housing market by shorting it just prior to the global financial crisis, and he managed to profit 20 billion US dollars by shorting the housing market. A lot of banks went bankrupt or went into financial trouble during the financial crisis, but we know that after the market bottoms, usually it will go up again. It is just a matter of time. How long does the market take to recover? So in early 2009, John Paulson managed to switch gears early, and he turned from someone that shorted the housing market and into someone that invested into financial institutions. So we saw a lot of financial institutions went into trouble, right? But he invested heavily into banks such as the Bank of America, Goldman Sachs, JP Morgan, Citigroup, etc. And when the market recovered, he managed to profit from all these banking stocks. So we see that not only he knew how to short, he also knew when was the right time to re-enter the market to become a buyer. So what you can do during market crashes, if you do not want to short the market, which can be risky, then you can just buy stocks when they become undervalued. Next, let us talk about Warren Buffett, one of the most popular fund managers of all time. Now, Warren Buffett has publicly shared about the secret to getting rich on Wall Street, which is to be fearful when others are greedy and be greedy when others are fearful. So this is the mindset of a contrarian investor, whereby a contrarian investor will act in the opposite way that the general market does. So when many people are frantically buying stocks, driving the valuations upwards, a contrarian investor may start selling off his shares. And when the market starts to panic and sell off their holdings during a market crash, then the contrarian investor will be the one entering and swooping up shares at discounted prices. Because ultimately, we want to buy low and sell high. So perhaps by being a contrarian investor, you are able to buy low and sell high and profit from the actions of other investors. Now, Warren Buffett said that he always likes to invest in established companies at good prices. So good prices means undervalued, which means the market price of the stock should be below its fair value. So at the tail end of the global financial crisis in October 2008, Warren Buffett announced that he was starting to buy up shares again. So he bought billions of dollars worth of shares in Goldman Sachs and also other large established companies in the US like General Electric and Dow Chemical. And after that, when the market recovered, he made profits from it because ultimately the stock market will recover. It just takes a matter of time, whether how long it takes, how many years before we go from a bear market to another bull market, right? So Warren Buffett's approach is to buy companies at good prices, good companies, and then hold them for the mid to long term. So this can be a very easy approach for people to copy. All you have to do is do your own research, find out which companies are undervalued, find out which have long-term potential. They also need to have good quality businesses, and then you invest in them and you just hold them for the next few years or even longer. So this doesn't require you to keep monitoring financial markets to see, oh, what is trending right now, what is out of trend right now, or what should I switch to next. You do not need to time the market, you do not need to understand too much about market cycles, what is happening in the economy. Of course, you need to understand what is happening in the economy, but you do not need to drill in too much details to try to keep rotating in and out of different types of companies or sectors. So this can be an easier approach compared to Michael Burry's approach. Now, personally, I'm a fan of both Michael Burry as well as Warren Buffett. Michael Burry is more of a risk taker. He shorts the market, he takes bets which may be unconventional because he looks at what the market is currently in, the cycle that the market is currently in, and he finds out a lot of things that people do not notice much. While Warren Buffett is researching more on companies that have good quality and good businesses, and then he just buy and hold them for the longer term. So whichever is your preference, it is up to you whether you like to choose Michael Burry's approach or Warren Buffett's approach. You can still make money both ways. Now, what about the recent market crashes? What did Warren Buffett do? Well, for the COVID-19 pandemic, in March 2020, when it was officially declared as a global health emergency, a lot of industries came to a standstill and the US stock market tumbled. Industries like travel and hospitality and consumer retail were hit hard, and earnings tumbled because people were not able to physically travel or visit malls anymore. Now, Warren Buffett held a couple of US airline stocks, and because people were not able to travel anymore, airlines were losing a lot of money. So what did Warren Buffett do? He sold off all his US airline holdings, right? So even though there may be losses, but he was willing to cut his losses and move on, and then he redeployed the remaining capital into the healthcare sector, which was a beneficiary because of the pandemic. So I hope that you have found this video helpful and that you have learned how millionaires and successful fund managers managing billions of dollars, how they react during market crashes and how they manage to profit from it. So recessions, market crashes may not necessarily be just a bad thing. It can be a good thing if you know how to properly react to it and make well-calculated investment decisions. So I hope you have learned something out of it. Give me a thumbs up, click on the like button, as well as subscribe to my YouTube channel by clicking on the subscribe button below. And if you want to learn about investing, you can also reach out to me because I also teach people investing in stocks as well as in cryptocurrencies. Well, crypto more to trading. So if you're interested in anything, just reach out to me, email me, and also check out the investment platforms in the description section below. There are multiple ways that you can increase your money, increase your wealth, and let's go towards financial independence, shall we? Alright, thank you, and I will see you in my next video.